bunch of firms, including Honda, Stellantis, GM, BMW, and Mercedes, are going to invest over $1 billion in building 30,000 charging stations between now and 2030. These charging stations are going to, come online beginning mid next year. They're going to complement the 32,000 charging stations that are already in place. Most of them are Tesla charging stations. And in fact, if we remember a couple of months ago, GM, Ford, and a few others also gained an agreement with Tesla that some of their electric vehicles can charge in the Tesla stations. Now, what's interesting is that both Tesla and the other charging stations use two standards. Tesla uses what they call the North American Charging Standard, and all the other companies like Electrify America, ChargePoint, EVgo use the CCS, or the combined charging system. These new charging stations are going to be dual use charging stations, having both types of chargers. Over time, what the automotive industry has decided is to move to the Tesla type charger. And with the Inflation Reduction Act and the investment in electric vehicles, there are going to be, between all these systems, over 180,000 electric charging stations throughout the country between 2030 and 2035. Why are these companies doing this? It's for business. All these companies have made announcements over the last year or so that they're going to transition their fleet from gas powered to electric vehicles by 2030 to 2035, depending on the company. And so this is going to facilitate their business model, especially when there's a common good that can be had. We've seen car companies join together to either defray capital expenditures or risk. So it's not uncommon that companies will do this for the greater good, both for the economy, for their bottom line, and for the consumer, and the shift to from consumers going from gas to electric powered vehicles. The U.S. economy grew 2.4% in the second quarter, which is fantastic. So the story is going to be the interest rates may slow down, the Fed may slow down the interest rates, and it's likely, at least not in the foreseeable future, that mortgage rates and credit card rates are going to decline. This quarter, growth was driven by business investment. Business investment grew 7.7% after basically taking a holiday in the fourth quarter of 2022 and the first quarter of 2023. And consumers are still spending on airline travel, on hotels, on restaurants, on concerts. So, as we saw last week in the box office, where the Barbie movie and the Oppenheimer movie had a record since 2019 of $300 million in that opening weekend. So consumers are spending. And so this week, at the same time, while we had this very good high-level economic news, the Fed did raise interest rates by 1/4 point. And they really want inflation to drop to that 2% target. And we had really good news in June. Inflation dipped to 3%, but an index that the Fed follows, called the Personal Consumption Expenditure Index, was released yesterday, and that was at 4.1%. That was a drop of 0.5 point since the last month. And the Fed really is looking at those two indices to kind of drive that interest rate to 2%. That's why they probably are still going to schedule one more interest rate increase sometime after their beginning in their September meeting date, all the way to the end of the year. The Fed has increased their interest rates 11 times since for the last 18 months. So hopefully that will come to a close. The two parts of the inflation that the Fed has not been able to slow down is rent increases and wage increases. And now, for the first time in over a year, wage increases are higher than the inflation rate. So that's why consumer confidence has been at the highest it's been in the last 2 years as well. So, bottom line, if we look at this, we see inflation declining, business and government investment kicking in, labor markets are still strong, and consumer confidence is high. This would portend very solid GDP growth till the end of the year.